All right, guys, I think we're going to get rolling. And I will just let in the people that are late as they come. So, welcome everybody. I'm sure, as some of you know, I've been hosting a monthly webinar now for about 6 months. And predominantly, we've been focusing on marketing for collision repair shop. I decided to do something a little bit different today. And I asked my friend Cole Strandberg if he'd be willing to come and speak to us about a little bit about what he does and also some strategy for growth in the collision industry through acquisition of other shops, because that is he is right in his element. So I'm going to soon turn this over to Cole. Be sure to jot down any questions you have as we go along. Feel free to put them into the chat. I will be kind of moderating the chat for Cole. So we'll be watching that. And if we have time at the end, we are going to have a Q&A for anybody that has any questions for Cole or myself. So welcome, Cole. Appreciate you taking the time to do this. It's a pleasure to have you here on our webinar.
Thank you for the kind introduction, Daniel. Really appreciate you and what you do, and excited to have a good conversation here. And as Daniel mentioned, please send some questions. Feel free to interrupt. Want this to be very conversational. Daniel, but I'll provide a little background here. You and I gave some presentations together at the Carolinas Collision Association. I think it was late last month. And what we have to talk about, while very different, goes together very well. You're all about the organic growth and helping build businesses via marketing and other tools. I want to talk today about some inorganic growth and how to grow your business by adding locations and by adding revenue, whether that be through acquisition, or we'll talk a little bit about greenfielding and brownfielding as well. Before we dive in, want to introduce myself. As Daniel said, my name is Cole Strandberg. I'm a principal with a company called Focus Investment Banking, where I spend my time specializing in mergers and acquisitions within the automotive aftermarket, specifically within that collision repair ecosystem. And so that's mergers, acquisitions, and capital raising for growing companies. By way of a little bit further introduction, I grew up around the collision repair industry. My family started a business back in 1988. It was a collision repair equipment distributor. So grew up all around and within the industry, and ended up going the investment banking route right out of undergrad. But a couple years in, the family business came calling, and ended up spending 6 years selling paint booths and frame equipment and welding equipment to the industry across the Southeast US. 3 years into that, we ended up partnering with a private equity group to scale ourselves. And I stayed on with those guys for another 3 years. We made 7 acquisitions during that time, quadrupling revenue, quadrupling headcount, and really that traditional private equity scale success story. Was also named last year in SEMA's 35 under 35 list, which was a really cool honor, and excited about that. If my face or my name looks familiar and it's not from any of that, it's probably through a really exciting thing that I get to do every week with Auto Body News, and that is host their weekly podcast called The Collision Vision, where we focus on the business side of the collision repair industry. I'll have this slide up a little bit later, but if you are not familiar, check it out. Daniel was actually a guest where we talked all about marketing just a few months ago, and really a great conversation. So I usually give this presentation live and in person, so I understand we're not going to answer this all together right now, but this is really for an audience of 2 different types of people, this presentation. Number one, business owners who are looking to grow or looking to kind of see what's next in their life cycle in their business. Number 2 is for folks who might want to own a business one day. A lot of applicable things for technicians or GMs who don't yet own their own company, but who would like to. The genesis of this specific conversation comes from somebody you guys all know very well, I'm sure, and that's Mike Anderson. Had the opportunity last year at SEMA to speak on a panel about mergers and acquisitions within the collision repair industry. There were 4 of us, I think, on stage in total, maybe 5, and we spoke for a full hour all about mergers and acquisitions, trends as it related to sales prices and who's buying and who's growing. And we're all feeling pretty good at the tail end of this presentation. And then a line comes for Q&A and some softballs initially. And Mike gets up and gets in line. And as you know, on for anyone who's been in an industry event where Mike is, the gravity that he carries when he does anything is palpable. So he gets in line and we're all like, all right, kind of hoping for a pat on the back. And he gets up and he says, guys, why did we focus so much on selling when we should be teaching folks how to buy and how to grow? And he was absolutely right. And so with that, I put these thoughts together in kind of a roadmap with kind of where we have to go together as an industry and as business owners with one, two, three, four shops, somewhere in there, some really cool options, some unique headwinds as well. And I have one controversial take that I've been bringing everywhere, it seems. And I'm not a controversial person. It's not who I am. It's not my nature. It's not good for business, right? I want to be happy, and I am. But my controversial take is this: the era of the single store generalist body shop is coming to an end. It's kind of a right in your face, right? Like, wow, why is that? It's been around forever, but there's a few reasons for that. As we know, increasing vehicle complexity, it's making these vehicles not only tougher to repair, but much more expensive, much more challenging. The training required, the equipment required, it's a different ballgame than it was 10 or even 5 years ago. We're also faced with a technician shortage, and folks who have been around in the industry know that's been a long time thing, but I think it's a little bit different now. It's a little bit more timely. If you look at the trends, it's a little bit scary, and there's more whip than there are technicians to handle it. And I don't think that trend is going away anytime soon. Insurance relationships remain a challenge. I think one of the positive side effects of consolidation we've all been looking for is, hey, when these guys get big enough, can they stand up and really kind of change the power dynamic in the industry? We haven't quite seen that yet, though I'm not writing it off. And there's a lot more. There's some real headwinds and challenges facing the industry, but that's not a bad thing. I think we're faced with a very unique opportunity that any of us out here are going to be able to do one of three things, and that is specialize, scale, or sell. And I want to talk about each of these three tranches and why there's real benefit to any option or a combination of any of these options. The one thing that I believe we cannot do right now as body shop owners is nothing and keep operating the same way we've operated in our single store generalist mindset. I want to talk about specialization first. This is one that I've developed this opinion after speaking with a lot of folks that I think is a uniquely good opportunity here. You have real industry thought leaders like Mike Anderson, Dave Lohr, and many others who are talking about we are not going to be all things to all people anymore. The OEs are saying it. Kelly Logan with Rivian, same thing. We are going to have to get really good at what we're fixing. That business model of fixing everything that comes through the door, that window is closing. So what are some niches in collision repair? I've seen some fantastic operations focused on some sensical niches that make some sense, right? You got EV repair, you got luxury repair, truck repair, but it can even go less specific than that. Domestics, Asians, Europeans, just be a little bit introspective. See, and looking at your books, what are you doing profitably? What is your team equipped to do and do well? And it's going to make a real impact if you can kind of pivot and do that. The why specialize is very much, in addition to what I just covered, a financial decision as well. Yes, might be a little daunting to start turning away revenue you would have otherwise taken. But when you can specialize, develop that brand within your marketplace for being very good at fixing X, you might see a short-term decline in revenue, but you're going to pretty quickly get that back and see a short-term, mid-term, and long-term increase at the bottom line, which is really what's important here. Was talking to a friend at the Auto Body Association of Texas show, and I'm not going to give him credit. I'm not going to give myself credit, but somehow this line came up and said, hey, this is a David versus Goliath situation. And David can beat Goliath. Goliath in this case, of course, meaning the consolidators and really any of the headwinds we're talking about, but not if they're fighting the battle in the same way. And so to find your lane, find your niche, and double down is going to really be a beneficial thing for your business and a very good potential option as well. Selling. This is what I spend most of my time doing. In full disclosure, the bulk of my work is sell side mergers and acquisitions advisory. I would tell you, kind of just from a high level, this is not where I want to spend our time today, but a market update. What I'm seeing is the single store, kind of to two stores, that sub 8, 9, $10 million in revenue range, staying pretty consistent in pricing. I think we might see some downward trends there, just minor. We're going from where these single stores in medium-sized markets used to have 3 or 4 or 5 big players fighting over opportunities. Now those are down to 1 or 2, but that price point is lagging. So I'd say those stores are kind of at that staying solid in valuation levels, which, as we get to point number 3 in scaling, we'll talk about how that plays into things. As we trend upward and we get to that 3, 4, 5 plus store group, we're seeing those valuations trending slightly upward, which is a good thing. So where your one store price point, just to really simplify it and generalize it, we might be in that 50 to 60% of revenue. When we're 5, 6, 10 plus stores doing 20 plus $1 million in revenue, we're certainly seeing north of 100% of revenue, and that's trending upward ever so slightly. The buyer pool, many of the similar names that you guys are very familiar with, the big 5, the national consolidators, all continue to be very active in the marketplace at varying levels of activity and conviction when it comes to buying versus building. So 2 of the 5 main players are coming out really swinging. The other 3 are at various levels of valuations when you get to the bigger deals. After that, I created this pyramid graphic to kind of show the buyer pool by different type of business. So at the very top, I have the smallest shops. Your buyer pool, that sub $1.5 million, $2 million in revenue, is typically going to be local and regional players. As you hit that 2.5 to $3+ million as a single store, you're going to start to open up to those national consolidators. And those bottom 2, I don't know if you guys are familiar with search funds, but essentially micro private equity funds and private equity, those are both really at the search fund level, call it $750,000 of profit of EBITDA and above. And then private equity for a platform, they're really looking for north of $2 million of EBITDA. A big reason why the valuations at that platform level, that 20 or so $million in revenue, couple $1 million in EBITDA, continues to move up as we have a real supply and demand issue. There are many more buyers out there than there are operations that meet those requirements, which I find very, very interesting. There we go. Can you still see me, Daniel? I had some technical difficulties on my end, but I think we're good.
Yes, I can see you. We're good.
Perfect. All right. So that supply and demand issue is increasing those valuations ever so slightly, but to an impactful level because they need to pay to get in, to beat the consolidators, because there are very few opportunities that if they want to get involved, they can take a swing at. And so all good things for operators in that space, certainly. So I want to talk scaling. And when we talk growing via rooftops and growing beyond your 1 location or 2 locations, there's 3 ways to do that, right? Number 1 is acquisition. That's where we're going to spend a lot of our time talking about. It's where a lot of the national consolidators and MSOs have really found to be their bread and butter and allowed for them to grow very quickly. But options like greenfielding and brownfielding for the right skill sets and the right organizations are very attractive. Could theoretically allow you to enter new markets and grow cheaper than acquisitions. You have different funding sources. There are some real positives there, and we'll talk about those. The biggest negative from my perspective is the uncertainty of what that looks like. And this is really kind of a secondary thought, but you need to make sure that you can fill that shop with work, but primarily the challenge with greenfielding and brownfielding, especially as you enter new markets, you need to be able to be sure that you can fill it with technicians and talent. And so the biggest reason that I'm going to really push this conversation more toward acquisitions is it's a little bit more certain with what you have and what you're acquiring and where you're growing. One question that I get a fair bit is how the heck are these groups paying so much money for these acquisitions? Or why is private equity so interested in the collision repair industry? And it's a good question. It's not the sexiest space, right? It's awesome, but why? And there's a few reasons. A major one is a term called multiple arbitrage. And there are very few industries that so clearly feature this arbitrage as a part of growth and scale. And so what multiple arbitrage means is essentially 1 + 1 is going to equal 3 or more, meaning as you grow, that multiple not only expands, or your business not only expands, your multiple expands. And so I'll talk a little bit about the mechanics of why acquisitions work. And spoiler alert, it's not because you go in and you make the business better, though that certainly helps. It's not process improvement that's going to just get so much extra juice from that squeeze. It's going to change your business and change your life. Part of it's truly just the value financially of scaling. So I want to use an example to define this multiple arbitrage. Say, for example, you have a shop doing $3 million in sales. They're at 10% of EBITDA, and say it sells for 50% of sales, or a 5 times EBITDA multiple. So we're selling that for 1.5 million, 50% of sales, 5 times EBITDA, right? The only visibility we have into financials, I have some when we do deals, but they're private. They're not publicly disclosed. The only public financials that we have in the collision repair industry are from a little group north of the border that you might be familiar with, and that's the Boyd Group, Gerber Collision and Glass, commonly here. To give you a sense of what they're trading for and what their valuation comes from. So say it was Gerber who just did that deal. As of the end of 2023, they had 2.9 billion in sales, an adjusted EBITDA of $368 million for about 12.5% margin, a little better than that 10% example we had there. So could bake in some improvement and some value. And they do help value it based on that in some cases, by the way. And a market cap as of 7/17. I went to pull it last night. That market cap had gone down a little bit, so I didn't like the numbers as well. I kept it from the original version of this presentation. That valuation for Gerber was $5.6 billion. And that's 193% of sales. It's 15 times EBITDA. So if you look at that example, do we think that buying that company at $1.5 million, call it 5 times EBITDA, 50% of sales, you think that drags this down, that 193 or that 15 times? In theory, if it's an efficient market, that acquisition is immediately worth now 193% of sales or 15 times EBITDA. So at a minimum, by acquiring that one store, they've 3x'd the value without a single process improvement, without a single change in the business, just by scaling. And so that's multiple arbitrage. There's other reasons to scale that are not directly related to the financial reasons. The first one is, you in theory, you work yourself out of a job. And this directly increases value. I will tell you the thing that is the quickest way to decrease a business's value is over-reliance on the owner. And when I work with people selling their business, there is without fail this desire, and it's believed, it's accurate, but to feel important and to highlight your importance for what you did to the business. But the fact is, the more you remove yourself from the day-to-day operations, the more layers of management that you can put in, the more valuable your business is to a buyer who's not going to have you moving forward. And that goes right into scale allows you to have the P&L that's going to afford putting in additional layers of management, that general manager level, eventually that regional management layer, and eventually an executive layer where you have a CFO, maybe a COO. As you scale, the reliability on one single person gets smaller and smaller. Additionally, that P&L is going to allow you to step up and pay what you need to pay to hire top talent. And that's pay from a rate perspective, but it's also the bigger you get, the more you're able to allow for competitive benefits and that 401k match and all that stuff, the more scale you have, the more money you have to essentially run through and make sure your roster is looking really, really strong. The bigger you get, also, I go back to that pyramid graphic, the more buyers you will have chasing after you at higher valuations. And so there is an immediate and direct impact toward what it looks like when a single store goes to market versus when an 8, 9, 10 store group goes to market. Very, very different buyer pool. And I want to talk a little bit here about what private equity looks like when they play into the equation as well. I mentioned multiple arbitrage again because it's huge. I'd reiterate, I've done transactions in multiple industries. Never have I seen so clearly the opportunity for multiple arbitrage where you can double or triple in value in acquisition just by making it a part of your bigger entity. So a lot of reasons. There's some reasons not to do this as well, and it's personality. It's, are you a technician who's grown into an ownership role who scale doesn't sound super compelling? You like being in the shop. You like having that shop culture that you are a part of. That's perfectly fine. I think the biggest thing when I speak with business owners looking at scaling is it actually what you want? Would you enjoy how this job looks tomorrow with 3 or 4 stores versus how it looks today with one? And if the answer is no, there's something to be said for a real value being placed on enjoying what you do and how you do it. So it takes some thought on, hey, is this really a good move for me? I will tell you, and I'm not going to bury the lead here. There are a lot of reasons not to grow, but they are all in that vein. Access to capital should not be one of those reasons to not grow and expand. Speaking of those reasons to grow, I've kind of highlighted 5 different ways of acquiring. I know before I got into investment banking and into the family business, acquiring sort of was like, wow, you write a check for a company, feels expensive. Plenty of folks do it. The big guys do it, right? Most of us here on this call probably not going to fund an acquisition just by stroking a check. I certainly could be wrong. Even if you can do it, there are probably some reasons to consider not doing that. Number 2, and I'm going to dive into this a little bit more, probably on the very next slide, if I'm not mistaken. It's take on investors, use private equity to grow. And I'm going to tell you about that mindset shift that we've seen here over the last 3, 4, 5 years. Traditional bank loans are a great option if you can get it. The debt is, like any debt right now, more expensive than it used to be. Banks sort of tighten their belt a little bit. It's a little bit tougher to get than it used to be. Seller financing is another great option. However, I would caution, I view seller financing as a filler of a gap, not as the primary source of funding. Love seller financing, but I like it as a tool to bridge valuation gaps, to keep sellers involved, even in a very small sense, but invested in the success of the company. Just increases likelihood that they're handing over the keys to something that they feel is not going to fall apart because they're leaving some of their checkbook in your hands to make sure that company can fund a seller note. But again, there's this craze lately of buying a business with $0 down, seller finance the whole thing. And I think people do that, but I'm a believer in you get what you pay for. If someone's willing to sell their business for 100% seller financing, I'd be questioning what exactly it is we're getting. The last one, and I'm going to dive way into this, is using SBA, the Small Business Administration, to fund acquisitions. And this is something that, even though I don't get involved with in my day to day, the discovery of this and the preaching of what the government has in place to help folks buy small businesses is really interesting. And I think a lot of people don't know the value that this tool can provide. I want to start first by talking about that taking on investors. So often when we think M&A, it's buying and selling, and that's not inaccurate. But I mentioned that supply and demand piece for platform level opportunities. Call it 20 million in sales. There's just so few of them. And so with that, I have 100 to 120 private equity groups I've spoken to in the last 2 years. And I've gotten a sense for what they're doing. And they all reach out and say, we want in collision repair. How do we do it? And I ask, what's your investing style? How do you fund acquisitions? What kind of rollover? What kind of carryover? You have to be differentiated. And I say all that to say the supply and demand leads to the fact that anybody who owns this platform level body shop group is in the absolute driver's seat. There is going to be a lot of interest to the point where if you can dream a transaction and what it looks like in terms of a percentage, in terms of uh, how it's funded, there's a lot of maneuverability there. You are the one who's interviewing buyers more so than the other way around. But this shift, this mindset shift has gone away from, hey, we sold to private equity, especially among a younger group of real up and coming collision entrepreneurs, to, hey, we've partnered with private equity. And so private equity, they'll buy 100% of your company, but they prefer, and there's a sweet spot, to have the owner stay on and roll a significant percentage of equity. And they'll describe this and the value of this in two ways. Number one, in the example that I'll use, we're going to buy 70% of your business. You're going to keep 30%. We're going to grow it together. So in that 70% acquisition, they'll say, hey, you're going to take some chips off the table. You're going to get some real cash up front, have a nice exit, and be feeling very good. But they're also going to say, hey, that 30%, that second bite of the apple, when we go to sell next, the goal is that that is worth more than, if not substantially more than, that 100% of the initial acquisition. And so the analogy I use is these young up and coming collision entrepreneurs are now looking at it and saying, do I want to own 100% of a grape, or do I want to own 30% of a watermelon? And a lot of times, if they do the math and they see, hey, I want to grow, I want to do this quickly, they end up saying the time is right for a private equity partnership. And that allows you to grow via acquisition at a speed that would be far beyond what we're going to talk about next, which is the SBA. It'd be far beyond cash. It'd be far beyond seller financing. They view it not as a sale, but as a partnership that's going to allow rocket fuel to be poured on top of the business that they've built to this point. So SBA really is one, and I didn't realize how little known this was across the industry. But whenever I talk to people about it, eyes tend to light up and say, the government's going to do what? So SBA has a program called the 7A loan program. It's their primary business loan program. It allows for either individuals looking to buy a business that qualifies for the SBA, or businesses already operating in the space looking to grow via acquisition. Now, the maximum loan amount for the 7A program is $5 million. This can go up when we add real estate to it, up to 10 plus million dollars if it includes real estate. That also changes the duration a little bit, but I'm going to focus on the business side today. And it's basically a credit limit from the government to go and buy companies with up to a $5 million limit. And as you pay it down, of course, that replenishes. You see the rates, just like any debt right now, have gone up, but it's typically prime plus a couple points. So it's going to be more competitive than a traditional loan you'd find elsewhere. And again, primarily goes toward buying businesses specifically. One other point I would point out on that, SBA as an individual typically requires a minimum 10% down payment that can be funded either by the buyer, an investor, or via a seller note. If it's a business who's already active in the space, in many cases, the SBA waives that requirement for 10% down. And put in a different way, would 100% fund acquisitions for businesses existing in that space. The eligibility requirements, the SBA will make you get a valuation. They'll dive deep into the deal after it's under LOI, but at a general level, you need to be acquiring an operating business. It needs to be a for-profit, no nonprofits allowed. It needs to be located in the US, needs to be designated as small under the SBA for collision repair. It's a pretty big company before you get out of that small designation. A big piece here, the SBA is going to require a personal guarantee. So the government, they want to fund businesses, they want to help grow. They're happy to do it at a pretty moderate rate, but they are going to get their money back. Working a couple SBA deals right now where we're talking this personal guarantee goes toward the existing business, goes toward a house, cars. They're getting this money back one way or another for sure. So be very cognizant of that. And your credit needs to be pretty decent. Nothing crazy there. So with that, I'd like to pause here before I go any further and open it up to any questions we might have. Any questions on the SBA, private equity, anything of that nature? Daniel, is anything in the chat at this point?
You bet. I have one here. SBA 504 loan is also a great option. Rates are better than 7A and can be used for long-term equipment and buildings. Cannot use it for working capital.
Yep,
I don't know if you can
absolutely. A
comment on
lot
that.
of Not a ton, because that's going to be outside of, I know 7A is kind of the pinnacle for acquisition financing. That's where I spend a lot of time. On the SBA side as well, I'd be remiss not to mention it is a government program, but it goes through local and national banks. And so if you have a bank that you've been working with for a long time, they'll likely have an SBA officer within the bank. If you don't, or if that doesn't work out, there are numerous now SBA loan brokers who traditionally do not charge the folks taking a loan any fees. They're going to have relationships with a multitude of banks and they pay their fees in the background. And so it's a great resource that's not going to cost you any direct money to, instead of going to your bank and maybe doing another one or two, they will in some cases bring your deal to 20, 30, 40, 50 different banks to find the best avenue for approval and the best avenue to get the most competitive rates. So I think that's all I had on the SBA. I did want to give a quick rundown on my firm as we close, and then I'll open it up again once more. Focus Investment Banking, one of the largest lower middle market investment banks. We work in 12 different industry groups. Myself, my partner, my team, we all focus exclusively in the automotive aftermarket. I mentioned it earlier. We do work on the buy side. We do work on capital raising. My bread and butter is really in the sell side and the capital raising side. Love working with growing companies and love working with business owners who at the finish line of their business gonna in one transaction make generational wealth. Really enjoy what I do. I'm not gonna run through all of these, but super involved in the marketplace. Love collision repair. Here are some of our tombstones. And I want to leave this up for a little bit as well. If you enjoyed any of the content we talked about here today, highly recommend checking out the Collision Vision by Auto Body News. Again, about the business side of the collision repair industry and some great guests like Daniel.
Thank you, Cole.
Yeah, and I'd once more open it up to any questions. And Daniel, thank you so much, my friend, for having me. Really appreciate what you do and appreciate the opportunity.
Absolutely. A pleasure having you here with us. A ton of knowledge. If you would like, feel free to unmute yourself or ask any questions for Cole. He obviously knows a lot more about financing and buying and selling than I do. So here's a great opportunity to pick his brain.
I had a very small question. You mentioned that within the auto collision industry, there's an SBA size cap for your business. Where does that fall within the industry?
Yeah, it's going to vary by industry, by type of business. There's actually subsectors as well, from body shop operators to equipment distributors, paint distributors, manufacturers. Typically, and I don't have this in front of me for body shops themselves, but typically that small designation is going to be anywhere from 4 up to $15 million. I think collision's on the lower side, but it's going to get close to the cap of that SBA transaction value, certainly.
Okay, great, thank you.
And happy to hang around as long as you'd like. Otherwise, Daniel, that is all I have, my friend.
You bet. Hey, appreciate you all coming out today. I'm happy to have experts on like Cole to share knowledge like this. Anybody else have any other questions before we wrap this up? All right, I've got some thank you chats coming in here. Cole, I don't know if you can see them or not. Um, you bet. Thanks for coming out. We'll look forward to hosting another one of these next month. And thanks again, Cole. Appreciate your time.
Thank you. Absolute pleasure.
You betcha. All right, guys, I'm going to end the call and we'll look forward to seeing you guys next month. Take care.